Hi, and welcome to the Personal Finance course. I'm Tom Mihawk, and this is our chapter on bonds. I appreciate you joining me for this chapter. We've talked about stocks already and why stocks are a great investment for the long term, and they should form the majority probably of most portfolios. For younger people, maybe most of your portfolio. For those who are risk accepting, most of your portfolio. The older you get, though, you need to dampen some of that volatility, reduce some of the volatility so that the portfolio is a little bit more predictable, not as risky. And one way to do that is with bonds. Bonds are the second security introduced in the personal finance course for a reason, because they're probably the second largest asset class of security that people add to their portfolios. So what is a bond? A bond is a debt or fixed income offering that pays interest as a percentage of the principal invested. You're actually lending money, where with a stock, you're buying ownership in a company. With a bond, you're lending money to someone who's borrowing from you. They promise to pay you a rate of return called a coupon rate, and the money that you lend at the initial purchase is called your principal. The principal is guaranteed to be paid back. Doesn't mean it always is. We have a slide about this later in this presentation about that. It is overwhelmingly they're paid back, but they're not always. But it's guaranteed, meaning that there is a commitment in a bond indenture, an agreement, a bond contract called a bond indenture, to pay you back. There are some risks, however. Payment of interest. If the company's not doing well, it may not be able to make its payments. Repayment of the principal, same thing. If the company's under duress, they may not be able to pay back. There's a chance of reduction in value over time due to changing interest rates. And this is really interesting. We're going to talk about this in a few more slides. This whole idea of yield to maturity and its impact on the price of the bond. And lastly, inflation. Imagine a company promises a 5% coupon when interest rates would dictate that 5% is appropriate for companies of that size and in that kind of industry. And what if interest rates go to 7 or 8? Well, suddenly new bonds, 2 years, 3 years later from the initial issuance, are paying 7 or 8. Well, the old 5% bonds are not as valuable. Who wants a 5% coupon to pay $1,000, let's say, for a 5% coupon when they can pay $1,000 and get an 8% coupon? So that pushes the price of the bond down. And so there are some risks in terms of value. Who issues bonds? Governments, federal, state, county governments, federal agencies like Fannie Mae, Ginnie Mae, Freddie Mac. Fannie Mae is Federal National Mortgage Association. Ginnie Mae is Government National Mortgage Association. Corporations of all kinds. Toward the end, I have some examples of actual bonds in the market. We'll talk about them. Companies you know, Netflix, Microsoft. So corporations of all kinds. And municipalities like local governments call these bonds munis. They often come, they frequently come tax-free, and that's a benefit for both the buyer of the bond and the issuer, the municipality issuing, because they can issue with less cost. So some types of bonds. Debentures are unsecured. They're like an unsecured line of credit. The issuer issues the bonds on the full faith and credit that they will pay back, right? A mortgage bond is secured with some kind of collateral. That extra comfort that lenders or buyers of the bonds get causes rates to be a little bit lower. There's a little bit more security that the bonds will be repaid. Subordinated means that they come behind another bond or security in order of repayment. It's like a second mortgage. First mortgage gets paid first, maybe like a home equity line of credit, has a second claim on repayment. Same thing with a subordinated bond. Because it's riskier, though, being subordinate, it pays a higher rate of return. So as risk goes up, rates of return go up. The issuer of the bond must pay a higher rate to get people to buy it. The longer the bond, 10 years versus 1, 30 years versus 10, in general, the longer the bond, the greater the rate of return, because the longer the lender has to wait to be paid back. And lastly, high yield bonds, called junk, triple B or less rated, are considered not investment grade, and they're junk bonds. And they have even higher rates of return. Depends on the time. High is relative. High now might not be the same as what high was in 1980s, but triple B or above is investment grade. Less than triple B is considered not investment grade. Some features: call privilege. What if a company issues bonds and offers a 5% coupon? Interest rates drop, and now companies similar to that company can issue at 3. Well, with the call provision, the company can say, you know what, we want to bring those bonds back. We want to bring them back. We're going to reissue debt, maybe not the same amount or with the exact same features as the old bond, but maybe not. But we're going to redo it. We're going to call them back and issue new bonds and pay the going rate of now lower interest. This call provision investors have to be compensated for that. And so in general, coupon rates are higher for bonds with call provisions. You have to pay someone for the possibility that they may only own what they thought was going to be a 10-year investment or a 20. They may only own it for 3 years or 5 years. The company can bring it back. And so that call provision, the issuing company has to pay for that with a higher coupon. A sinking fund is like consistent saving toward repayment of the principal in the future. It's kind of like the way the Internal Revenue Service requires taxpayers, individual taxpayers, to withhold. You're not really paying your taxes then. What you're doing is you're saving toward a tax bill that's due on April 15th of the following year. And the same thing with a sinking fund. A sinking fund is a way of saving toward being able to make repayment at the end of the maturity, at the end of the term of the bond. It's more comfort for the borrower, the buyer of the bond. And last, conversion to stock potentially makes a bond more attractive by offering this conversion to stock, which has the possibility of raising rates of return. As we saw in the last chapter, the stock chapter, stocks overwhelmingly have greater rates of return over long periods of time. And so the opportunity to convert to a stock means that you might be able to get a greater return than the initial coupon rate. For the issuer, this is the borrower, the company borrowing, issuer of the bonds, it allows them to price it a little lower maybe than, say, a debenture. And it gives the buyer of the bond a chance to convert at some point in the future to stock and have a greater return than the bond would have given them had they held the bond through the full term to maturity. So why invest in bonds? Why do we invest in bonds? It has a required repayment. You know that when you invest in a stock, there's no requirement of repayment. So you could invest in stock and never get your money back. Most times you will. Most times if you invest in stock that you take an interest in and you research and learn about, you buy Apple stock, Google stock, Amazon. Your goal is for it to grow in value, not lose value. But it could. And companies that you don't know as well that hopefully will grow maybe even faster than those names, you might lose if the company doesn't do well. Bonds are required to repay you. And that requirement means that you get less rate of return, but it's more consistent. It offers regular income. Usually it's paid twice a year, maybe once a year. So income is paid regularly throughout the term of the bond. It may offer growth potential too. We'll talk about that more when interest rates change. If interest rates go down, bond prices go up. It gives you a chance potentially to sell the bond and make a greater profit than you would have had you held the bond to maturity and received just the coupon payments and your return of principal. Safety. We can measure the safety by the rating the bond gets. We'll talk about that later in the presentation. By the size of the company, the industry they operate in, how old the company is, how experienced the company leadership is. But nevertheless, there's more safety. And it's an important diversifying securities for portfolios, lowering risk and lowering volatility. If you knew that buying Apple or Amazon stock would always go up and that it would never go down, and that if you needed it in 1 year or 2 years or 10 years, you could count on it being up, well, that's great. Own only Apple or Amazon stock, but that's not the case. That's why we recommend diversifying. In a portfolio that requires some dampening of risk, or maybe keeping risk the same to get a little bit higher return, bonds bring this important dampening effect, this important lowering of volatility when mixed with other investments to provide more assurance of return or lower risk to a portfolio. So some bond details. First, you have the par value or the face value. It's the amount that you purchase in the beginning. It's a unit value, usually 100 or 1,000. So if you buy 1,000 bonds, you're going to pay 1,000 times 1,000, whatever that is. 1,000 times 1,000. $1 million is your purchase for those bonds. If the par value were 100, it would be $100,000. Usually in unit size of 100 or 1,000. That's the par value. The coupon rate is the percentage that the company or the borrower, that might be a government agency or a government entity, it's the rate that they say they'll pay relative to the par value. 5% means a 5% coupon relative to the par value. Maturity is the length of time of the bond. 10 years, 20 years. It's, you make your purchase if it's at issue in year 0, and in year 10 you get your money back, or year 20 you get your money back. But you may buy bonds at the issue or later, during the time the bond is in the market. And you may sell it at maturity or during the time the bond is in the market. I think of it like this. Let's see if I can get this. This is a sort of vector diagram. Hopefully you can see this. And in the beginning it shows the down arrow on your left side, and it says bonds bought at issue, and it's a par value, and it shows a down arrow, meaning that you're paying out. And every year through years 1 through 10, you receive a small coupon every year. That's a plus arrow, small amount. The term of this bond is 10 years, and the coupon rate is a percentage, and it's again a small amount relative to the amount invested, the principal amount invested at the beginning. And at the end, right here, you get your par value back and you get a coupon payment. And so bonds work in a very sort of symmetrical way like this. Now, why are bonds so cool? Bonds are so cool because of the yield to maturity. It's a great arithmetic relationship. It estimates the return, the rate of return for a bond investor if it's held to maturity. If you buy a bond at issue and hold it to maturity, the rate of return is the coupon rate. But what if you buy it later? Well, the bond price might be higher or lower than face amount or par, in which case the coupon stays the same, but you have a new calculation of your rate of return to maturity, and that's called the yield to maturity. Market prices for bonds vary as interest rates change. When interest rates increase, new similar bonds issue at higher rates because they have to be competitive. No one would buy them if they didn't. So when rates go up 2 years, 3 years later, companies issue at the new higher rate. So the old bond with the old coupon rate now has a lower price to compensate. It makes the price of those bonds go lower. The old, less valuable bond is now able to be purchased at lower prices than par. It's called a discount. In combination with the coupon payment, with the rate is unchanged of the coupon payment, it makes the yield to maturity greater than the coupon rate. So when you buy at a discount, the yield to maturity is greater than the coupon rate. When interest rates decline, the old bond is worth more than due to the higher coupon relative to market rate. So if interest rates decline, new companies issue 2 years, 3 years, 5 years out. They issue at lower rates. So the old bond's coupon is now more attractive. And so people pay a premium for that. When interest rates decline, the old bond is worth more. And so the yield to maturity is less than the coupon rate. It reflects the fact that you have to pay more than par value to get the same coupon. And it means that the yield to maturity is going to be less than the coupon rate. The effect is that when interest rates go up, bond prices go down, and when interest rates go down, bond prices go up, and when interest rates go up, bond prices go down. That's the upshot for bonds. It's what's so cool about bonds. And this is the end of the first segment of the chapter on bonds.